You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Option Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. And the Wide World of Options radio show is one of the ways the message is spread. OIC also offers a variety of other resources to those interested in learning more about options, including webinars, podcasts, and live events. For more information, check out optionseducation.org. Now, here's your host, OIC's Director of Individual Investor Education, Joe Burgoyne.
Today's program is a rebroadcast from OIC's webinar program. Every month, we do webinars on a variety of options-related topics. Check out optionseducation.org for more information. Enjoy the show.
Good afternoon, ladies and gentlemen. We're going to get started. We're glad you could join us for the latest installment of the Options Industry Council's webinar series. My name is Alexander, and I'll be guiding you through today's panel discussion, Volatility, the Fuel That Moves Options. I'm pleased to welcome our moderator today, OIC's very own Ed Modla. Ed is the Manager of Investor Services at the Options Clearing Corporation. Ed began his career with Hull Trading in 1997, where he served as a market maker for index options. He was a highly successful professional trader for many years in the equities, options, and futures markets before entering the service side of the industry. And now, ladies and gentlemen, Ed Modla will bring you our topic today, Volatility, the Fuel That Moves Options. Ed?
Thanks, Alex. Happy to be here today and want to welcome our panelists. We'll introduce them in just a minute here. We're going to talk volatility today, get into some definitions and insight. We went through our session last week, purely educational. This week, we'll take it to the next level and get some deeper background on volatility and utilize the knowledge and experience of our panelists to give some insight to our audience into how professionals are looking at volatility and using volatility measures to make trading decisions. First, let's cover what the Options Industry Council is. We always get a lot of new attendees to our events, so for those of you brand new to our presentations, the Options Industry Council is an industry cooperative providing unbiased education about equity options to investors and professional advisors and traders. Before you open a live account and trade options, you do need to read and review the characteristics and risks of standardized options. Options are not suitable for everyone, and a deep understanding of how options work is essential before trading them in a live account. The Industry Council operates as an industry cooperative. The exchanges you see on the screen are where all the action takes place. Of course, your orders will go through to the exchanges and be working orders or executed orders, but from our perspective here, these are partners of ours. These exchanges are reviewing educational material that we provide. They're also providing personnel and presenting talent at our various events. Looking back at the industry, for those of you who have been at our events in the past, options volume has exploded. You've seen this slide before. At the turn of the century, you saw a nice uptick for a multitude of reasons. Certainly electronic trading played a big role in that uptick in volume, but also we cite other things. People are managing their accounts more proactively. The age of do-it-yourself investing took a strong hold, and we like to point out awareness about options trading. So educational entities like OIC or mentorships or education at brokerage firms that you'll hear from personnel in both of those areas today at our panel, all plays a role in getting people out there trading options. In 2018, we just closed up the first quarter, and we've seen an uptick from what you see as a leveling off over the last handful of years. Those numbers represent about 16 million contracts a day. So far this year, we're about 30% or so above that, up above 20 million contracts a day. So people are using options. They're using them more frequently, and the industry is showing no signs of slowing down. So let's get to our panel and start the discussion on volatility. First, we'll do introductions. Dan Passarelli is the president of Market Taker Mentoring, and we're glad to have him here. Dan, thanks for your participation today. Can you give the audience a little bit of a background on your history in the business and where you stand today?
Sure, absolutely, thanks. So yeah, my name is Dan Passarelli. I was a trader on the floor of the Chicago Board Options Exchange for a number of years. I'm the author of Trading Option Greeks, as well as the Market Taker's Edge. And I love contributing to the OIC when they have their educational opportunities here. Our website is markettaker.com. We create lots of educational opportunities from one-on-one mentorships all the way down to ebooks. You can get one of our free ebooks at markettaker.com/ebook.
Very good. Thanks, Dan. Again, thanks for being here. We always appreciate the participation from industry experts like yourself, and we look forward to hearing from you. Our next panelist, Sean Howell, who's Senior Strategist of Investor Education at E-Trade Financial. Sean, a little introduction of yourself to the audience.
Well, thanks, Ed. Thanks, everybody, for joining. I appreciate the opportunity to talk about something I absolutely love talking about, which is options, and volatility goes right in line with talking about options. Hey, by the way, thanks for the picture from a few years ago, which is nice to see. A little bit younger Sean there. I've been in this industry now for literally half of my life now. I've been in the industry since 1994. I got started when I was about 24 years old, started at Schwab, spent 10 years there. Found myself working with a lot of option traders, doing a lot of options education, really found that education for the retail customer was my passion. From there, I left Schwab in 2005 and went over to Invest Tools to teach options for a number of years. And then there was a merger with Thinkorswim. Worked with Thinkorswim for a few years as well. And then really went out on my own and did some individual consulting from about 2009 right up until joining E-Trade this last July. In fact, one of the reasons that we joined E-Trade is that they were our biggest client. We did a lot of E-Trade webinars. We did a lot of E-Trader education days, working one-on-one with some of their clients. And so I live and breathe education. My specialty is really strategies and options, and worked a lot with OIC. So this is another opportunity to keep working with the partners that we enjoy. So thanks so much for having me, and this should be fun.
Excellent. Thanks, Sean. We're both of you guys, we're very glad to have you. I've got a lot of questions for both of you, but first I do want to start by gauging the audience a bit just to see where we stand. And this question is a little bit deeper than just do you look at implied volatility levels, or do you scan implied volatility levels as you're analyzing a trade, but do you actively track implied volatility levels during your trade, while your trade is open, while you're managing your positions, always, sometimes, or never? And like I said, this takes things a little bit deeper and one step further than just being aware of what implied volatility is. And it looks like we're getting some good responses, so thanks for everyone responding. Let's put up the results here. And not too surprising that we see a split across the board, a little bit in every category, but the sometimes and never categories are there at the top. So we'll spend some time on education near the beginning stages of understanding implied volatility and Vega and how that all works. But we've got something for everybody today. And I think I'd like to start back with you, Sean, if we could just set the foundation for implied volatility. So in your view, how would you define historical versus implied volatility? And when you look at a specific number, say 20% or 30% implied volatility, what exactly does that number mean?
Yeah, it's a great question and probably the best starter question for us to get going here. So first of all, let's define what historical volatility is. Historical volatility is just looking backwards and looking at the magnitude of a stock's move. How much has it moved over a certain amount of time? And then we take that statistical reality and we look at the plot points and we figure out how much has this thing moved, where has it gone, and we look at it on a bell curve and we determine the standard deviation from it. And from that standard deviation, we're gonna show that as an annualized percentage. So I think you'd use a number 20. So if I'm looking at a stock that historically, or I should say now is at $100, I can assume that it's been somewhere between 80 and 120. And if it's averaging now at 100, that gives me an idea of where it's been. And the idea is not so much where it's been that's going to continue that in the future, but that gives us a benchmark to compare something against. And the thing we're going to compare against that is the implied volatility, and that's really the important one that we're talking about right now. The implied volatility is what is the market willing to pay and where do they think it's going to go. If it has a historical volatility of 20, then it's really gone up or down about 20% over a defined range. But if the market's showing us an implied volatility of 30, then what the market is really telling us is that the people that are buying the calls and buying the puts think that the magnitude of the moves forward, predictive, is going to be greater than what it was historically speaking. So that's an indicator there that the market thinks things are going to pick up. And if it has a historical vol of, let's say, 20 and an implied vol of 15, then really that means that the market is anticipating or predicting, if you will, or speculating that the magnitude of the move is going to be less. So it's a predictive move. And I know Dan and I are probably going to go into much greater detail, but that's the general outlook here. Is it's one standard deviation move on an annualized level, utilizing one standard deviation to help you determine your values.
That's great stuff, Sean. Let me ask you, when people look at an implied volatility, as you mentioned, it might be below historic, or maybe the implied is above historic. And sometimes people think that means the option is cheap or it means that it's expensive. Can you just spend a minute and talk about your view on the relationship between implied versus historic and how you weigh those two numbers versus each other?
Yeah, it was interesting in the poll that we had about 2/3 of the audience that aren't really looking at the implied volatility moving forward, and I think it's really important that you do. As important as looking at a stock's 52-week high or 52-week low. So I think as we conclude this session, if we were to do the poll again, hopefully the numbers would be 100% people would be looking at the implied volatility levels. But it's the relationship of the implied volatility relative to the historical volatility. So let's say that I look at a stock and I see that it has historically, volatility has been as low as 20 and it's been as high as 50. And then I look at it right now and I notice that the implied volatility, the market is willing to pay with a volatility of 50. Well, if I'm the buyer of a call option, it doesn't really matter what the price of the stock is relative to its 52-week high or 52-week low, but that's telling me that the option is priced right now at its 52-week high. So if a buyer of an option, I need to know that I'm actually willing to pay, if I'm ready to hit the buy button, I'm willing to pay more than anybody else has for that amount of time for an option at this particular level right now. In other words, it's a very expensive, or some people would often say overpriced, meaning it's priced more than what it historically has or should have been priced at. So if you're willing to pay that, then the idea is you're expecting volatility to go even higher than 50 right now. Now, instead of paying that, of course, we'll be talking a lot about option selling as well. An option seller may be thinking, hey, if I'm going to sell a covered call or sell a naked call or sell a cash secured put or a naked put, I can get more today for that particular option than in any other time in the past 52 weeks. So since it's a two-sided market, it's important to know where the current level of implied volatility is relative to historical. And let's take the other side of that. Let's say that that the current level of implied volatility was at 20, again in that 20 to 50. Options would be considered underpriced or cheap at this point in time. The idea is, hey, the market doesn't anticipate a big move, so options as such are going to be priced lower. I can get in and buy that if I anticipate the volatility is going to increase. Then the increase in volatility, or we say the expansion of implied volatility, is going to make the options that I paid cheap more valuable. In other words, we go back to the old buy low, sell high system of buying and selling things. So we have to know where it's at right now, and we have to know where it was previously, and we have to know are we towards the higher end of that or the lower end or somewhere in between.
Mm-hmm. Very interesting and really good stuff. Let me ask one more thing of you, Sean, before I turn to Dan. This concept or term, historical implied, I'm not sure if that's another type of volatility or how you would look at that, but when people say that they're analyzing historical implied volatility, what do you think? How would you describe that to the audience?
Well, the way that I look at historically implied is if someone was willing to pay a certain implied volatility or a certain amount. In fact, I'd gone back and taken a look at a chart of Apple. If you go back to September through November of 2017 and you look at what people were willing to pay when it came to the implied volatility, for Apple, they were paying 23. They were paying a vol at 23. But if we go back and we take a look at what Apple really delivered, in other words, the realized behavior of that, it was only about 17. So if people were willing to pay 23, but the realized or the historical actual was only at 17, means people overpaid for it, which is very typical that people overpay, but it's how much were they overpaying. If you go back and you look at a chart and on your chart, and you can do this on E-Trade's platform Options House if you include the volatility function, you could take a look at where the implied was relative to the historical. Now, it's very typical that implied is going to be higher than the historical. If it wasn't, nobody would be buying and selling options. But anyway, how, to what magnitude is it greater than the historical? And if you look back at Apple, you'll see that it was greater by about 6 points, which is quite a lot, and it stayed that way for about 3 months. And then if you look at that, you'll see that the historical actually went above the implied, meaning volatility was cheap, that the price action or the price behavior, the realized move of the stock, options were looked to be a pretty cheap value at that point in time. So that's how I look backwards at it, to take a look at the historically implied and see if people were overpaying. Typically they do, but just how much were they overpaying for what they ultimately realized in the move of the stock.
Okay, great. Sean, that's a great foundation. We've talked about implied, we've talked about historical, looking and tying those things together. Let me shift to Dan now for a little more application of volatility. Dan, what metrics do you use when you're analyzing the market, looking for opportunities? What kind of metrics are you looking at, and how do you use them?
Sure. Well, at Market Taker, we teach a methodology that we call the 1, 2, 3 volatility analysis. And at the heart of it, the bread and butter is historical volatility and implied volatility. And it follows along a lot with what Sean just described. We first look at implied versus historical, today's implied versus today's historical. We look at today's implied versus the implied of the past, and then we do a little bit of forecasting on future historical volatility, which of course is another one of those seeming contradictions, future historical. But we use those. We of course look at Vega, because Vega is what I like to call sort of the great translator. It translates these sort of esoteric mathematical numbers into actual real money that you can put in the bank, hopefully, or spend on something. It translates the esoteric into the real. We use that. We use different volatility rankings like volatility percentile, and just a lot of comparisons like that. I mean, to be sure, as far as actual tools go, a volatility chart is one of the most essential things for any option trader to master.
Very good stuff, Dan, and a lot of info there. I noticed you mentioned implied today versus implied in the past versus implied in the future. A lot of moving parts there, but a good deep analysis and very thorough. Sean, same question to you. What metrics do you look at? How are you using them? How are you interpreting volatility levels to help you make trading decisions?
Well, going along with what Dan was talking about, and I know that Dan came off of the floor, back in the day when I initially started in the late 90s, we didn't have the tools as a retail broker and as a trader myself, of course. It's a funny question. People say, do you trade? Of course I trade. How could I not? But anyway, we really didn't. We were directional traders. We were lucky if we had charts, and if we did have charts, we probably had to pay for them, but we didn't have all of the tools that, that the market makers had these great tools. And I think it's just phenomenal now that we, as retail clients, are really learning some of the strategies that people have been utilizing in the pits for the longest time, and we finally have these industrial grade tools, and it's great to see. But when we didn't have those tools, how do you start looking at some of these things? And one of the easiest ways that I have always looked at it, and I do this on a regular thing, and I teach this as a regular thing, just go ahead and consider if you were to buy 100 shares of SPY right now, so the S&P 500 exchange traded fund, we don't need to look at the index itself, let's just look at the SPY, and then figure out what you could get for selling an at-the-money call, as close as you can get to at-the-money. We don't need to fudge the numbers very much, just run the calculation. If I were to buy 100 shares of SPY and then immediately sell a 30-day at-the-money covered call, what's my yield going to be? And if you go back to a couple of months ago when the VIX was extraordinarily low, and that's another thing I'll talk about in a minute, when the VIX was extremely low at historical lows, that little exercise of buying the 100 shares of SPY and selling a 30-day at-the-money covered call on that was going to yield you about 0.47, or just about 0.5%. So you keep that number in mind. And then you run volatility, you run the number again when the VIX is over 20, which took a long time for it to get up there. Actually, didn't take a long time, but it had been a long time since it had been up in the 20s. And you're going to find that the yield's kicking off about 1.7. Right there, just what changed? And what changed was volatility. And going back to what Dan was talking about, Vega. Vega is the driver here, or Vega is the way you can calculate how much an increase or decrease in volatility is going to either make you money or lose you money, depending on what you're doing. So right now, if you run the same number, we're right about 1.45, I think, is what I ran it this morning. So that's one of the starter points is, what am I getting if I'm going to do a covered call, or vice versa? What am I going to have to pay as a percentage if I'm going to buy that 30-day at the money? And if I do that every couple of days or weeks, it gives me a feel for how volatility is being factored into the market. So to me, that's the simplest way. The second thing that I take a look at is beta. Just about any broker should have the beta for a stock. And of course, beta is going to be the relationship of the underlying to an index, most commonly the S&P 500. So if I see a stock has been trading at a 1.5 beta, that's pretty backwards looking, but I already know that stock is trading another half as volatile as the market in general. Or if it's trading with a beta of 2, I know historically it's been trading about twice the volatility of the S&P. That's going to be a pretty wild ride. Or if maybe I look at a utility stock and I see that it has a beta of 0.5, I know that historically speaking it has pretty low volatility. So I don't have to get into too much of the complex calculations to know that beta is going to tell me historically what the price behavior is, and running these at-the-money calculations give me an idea of what it is forward-looking. But then just on my iPhone, I always take a look at the VIX, and that's going to be the volatility index. I also look at the VVIX. I look at the volatility of the VIX to see how volatile the VIX itself is. And then I look at skew, and I know Dan's probably going to be talking about skew here in a minute, so that'd be a good time to exactly define what it is, but those are the volatility metrics that I generally look at, keep an eye on, and teach people as well.
Great information from both of you, and I noticed both of you mentioned Vega. Sooner or later, Vega was going to have to make its way into this conversation, and we'll get there in a few questions down the line and dig a little deeper into Vega. But for now, Let's ask a question that sticks with the implied volatility levels. More specifically, I'll turn back to you, Dan. Pretty straightforward. When you buy a call or you buy a put or you're buying options, you're buying volatility. When you're selling options, you're selling volatility. That's pretty straightforward. But can you give our audience a description of how things work with spreads? If you buy one option, you sell another one, and maybe walk through an example. How does your volatility position look at the start? And if the stock starts to move, how does that volatility position change? How do you look at that?
Yeah, this is where things really kind of, because when you're trading a spread, we'll just talk in the context of a vertical spread, say maybe a call debit spread or a call credit spread. So, you think about that and you think, well, I'm buying one option, I'm selling another option. Am I buying or selling volatility here? And the answer, of course, is both. But what we do is we kind of narrow in on that, and we look at how much volatility affects each of the individual options. And at risk of getting a little far ahead of ourselves and getting into Vega, that becomes a very, very important distinction, and it becomes a very, very important analysis for trading. And in fact, what it actually really does is it guides our strategy selection, because whenever I trade an option, I'm basically trading three things. We could argue that maybe there's a couple more thrown in there, but basically three things. We're trading direction, we're trading time, and we're trading volatility. Now, we know that any option position we put on, we're trading direction, time, and volatility. But the more sophisticated we get as a trader, and frankly, the better we get as a trader, what we do is we narrow in and fine-tune how much sensitivity to direction do I want on this trade, and how much sensitivity to time do I want on this trade, and same with volatility. So when I trade, say, a vertical spread, let's look in the context of a debit call spread for this example. I would trade a debit call spread if I'm bullish. But I know that if I buy a call, I'm taking on positive volatility exposure, positive exposure to implied volatility, which means if implied volatility goes up, it helps. If implied volatility goes down, it hurts. Now, there's nuance here. Typically when an underlying stock rises, not always the case, but typically when an underlying stock rises, implied volatility tends to fall. Now, if I'm buying a call, I kind of have two different things going on here. I'll make money on direction, but I'll probably lose a little bit of money on volatility. So that's one of the advantages to buying a call spread instead is first, and the most blatant impact that has, is it when I buy a debit call spread instead of just an outright call, I lose some of my directional exposure, but I lose a ton of my volatility exposure. My volatility exposure decreases by about 90%, so I create sort of a natural hedge. Now, the other nuance there, which is a little bit less obvious, is that when the underlying stock rises up through the long and to the short option in this debit call spread, I actually end up with negative volatility exposure. And so when implied volatility falls, I'm actually putting that to work for me. I'm putting an additional element of potential profitability on my side. So getting good at this stuff really helps us to be better strategists.
A lot of good stuff there, Dan, and very dynamic as you described, monitoring the positions. These things change, and if the stock moves from a long to a short, you might see your volatility exposure flip and change on the fly. Speaking of changes, Sean, you're watching the markets. You're seeing what's affecting volatility. A couple of questions about those changes. First of all, what factors do you think most drive these changes? I know there's a lot of them, but what do you think are at the forefront of those drivers of change? And when volatility does change, where does it change? Does it change for an entire stock at every expiration date or certain strike prices? How does volatility change when it does?
Yeah, it's a great question, and when I ask people what fuels stock price movement, I get usually some real deep answers: news, earnings, products, management, and no, you're all thinking too deep. What drives stock prices up and what drives stock prices down? It's people pushing buttons. Buyers willing to pay higher prices. Sellers wanting to get out of a position. So if we really had to distill price movement down, you distill it down to emotions. Everything else is just facts, and facts drive decisions, and decisions are primarily driven by the emotions around those decisions. So it's the same thing with implied volatility, is that the emotions, the greed and fear, supply and demand. So let me see if I can bring this down to like a real world example here. So let's say we're looking at a $100 stock. That's always the simplest way to do some math here. We're looking at a $100 stock, and we're thinking about buying this. Doesn't matter if it's puts or calls, but we're thinking of taking a directional position in it. So we go ahead and we look at the price of a 30-day $100 call. So that's an at the money, and we look at the price of a 30-day put. That's the at the money. And we see that the call is priced at $3 and the put's priced at $3. We'll keep everything real nice and simple here. And so you're going to wait another night to think about your direction. Are you going to buy the call for $3? Are you going to buy the put for $3? Or are you going to buy both the call and the put for $6 in that case? But then the CEO in the middle of the night, I guess, had a few too many glasses of wine and decides he's going to tweet out to everybody, hey, tune in next Wednesday for an important news announcement. So I ask people, does this sound like good or bad news? It's funny how they will say, though that sounds good. No, I intentionally use those words to not tell you if it was good or bad. But what you know is next Wednesday, the CEO is going to be releasing some information. So you conclude, yeah, I think it's going to be good information, but somebody else maybe thinks it's going to be some bad information. So the next morning you get ready to go in there and buy that call option for $3. And by the way, the price of the stock has not moved one bit at all because it doesn't know which way to move. There's no new information. The only new information is that next week there's going to be some kind of an important announcement, but there's no color around that at all. So you go to buy that call for $3 and it's trading at $5 and you're stumped. Why did this thing go from 3 to 5? That's implied volatility. Because people aren't buying the stock and they're not shorting the stock. Instead, they're utilizing options. There is an increased demand in people wanting to either hedge a position by buying a put or to speculate on a directional move by buying a call or buying a put. And so that manifests itself in increase in demand, which increases the prices, and then that's spit out in a calculation in the Black-Scholes model is higher implied volatility. So implied volatility doesn't create higher prices. It's people's emotions and demand of the stock that is spitting out the higher implied volatility. So that being said, I think the second part of the question was, does it apply to all options? Well, let's change this a little bit from being there's going to be an announcement next week, because we know there's weekly options. Let's just say that the CEO tweeted out and said a month from now. So now we're looking at it a month. Where are we going to see the increase in option values? If you know that this event, and this is typically called a binary event, it could be good, it could be bad, but we know there's something over the horizon here 1 month out. What options is that going to affect? Is it going to affect next week's options? Well, not really, because next week's options do not encapsulate this event that, as I changed my time frame, is now out 1 month. So next week's options are probably not going to see very much increase in their overall values because people recognize that, hey, it's just trading on really no new information next week or the second week. But the third week out, maybe we're getting a little bit closer. Maybe people speculate there will be some consensus on this being a bullish or bearish announcement that's going to be released. But most definitely, anything 1 month out is going to encapsulate this binary event. So therefore, anything 2 months out, 3 months out, 4 months, so on and so forth, anything that encapsulates that event should also include this increase in values. And this is an important lesson, I think, because when people recognize, let's say in September, that Apple very typically will announce new products, you'll notice that around that time frame, they just don't know what week it's going to be. You'll start to see an increase in overall valuations of those options that encapsulate those kind of events. So probably going into more detail than we have time for, but that's generally what is driving the implied volatility. It's human emotion, supply and demand.
That's great stuff, Sean. And as you said, ultimately, changes come down to pushing buttons. Who's buying, who's selling, where's that supply and demand coming, and the changes could occur differently across expiration dates depending on what type of event and the timing of that event. I think this is a good time for us to get a little bit deeper and a little more complex with this discussion. And as I do that, I'm going to ask the audience to respond to another poll. This is more current event related. And I'll ask our panelists to weigh in for just a minute as this poll sits up here. How are things going for you in the recent period of higher implied volatility levels as we've seen the VIX go up and down, up above and down below the 20 level for the first time in quite a while? Maybe things are going really well for you. Maybe you're struggling in this environment, or maybe it's confusing you and you've had a hard time figuring out just what types of trades you want to do. While this poll sits up here and the responses come through, first Dan and then Sean, just a brief comment on what are you seeing as you're looking at the markets, where we stand with implied volatility, where we have been recently, and maybe how we got here. Dan, you want to start this off?
Yeah, it's been very, very interesting, really. I mean, there's many traders who talk about what an interesting market this is, compared to the boring market that we were in. And, before we had this surge of market volatility, there was about 2 years where I was saying, wow, this is a really interesting market because it's so boring, because it's such an anomaly where, volatility, implied volatility is getting squeezed so much. It was generally speaking, there's a premium in implied volatility, meaning volatility is historically overpriced, but it was getting to the point in a lot of cases where it no longer was, where option selling strategies were losing some of their luster. And it was kind of fascinating to watch because it was kind of, the first time we'd seen that since the crash of '87. Now, however, with the return of volatility, we've got a couple things. We've already talked about how there's different types of volatility, historical and implied. We've seen a surge in both of those things. And that arguably benefits both option buyers and option sellers. It benefits option sellers for the obvious reasons, because they can sell options at higher prices. But it also benefits the more savvy option buyers who are looking for those bigger moves and are willing to pay for the leverage that options provide. So, from what a lot of my students have been telling me, it's been really good for them, and they've welcomed the increase in volatility we've seen lately.
Yeah, very good. Good insight there, Dan, and the responses are trickling in. Thanks, everyone. I'll let a few more as we're waiting for a few more responses to come in. Sean, any thoughts there on current levels, what you're seeing, where we've been, how we got here?
Well, I'm glad that we got here. I'm personally enjoying having a little bit more premium available for me as an option seller. Iron condors actually make sense again. Before, running some of the numbers, it just didn't make any sense. So I'm enjoying some of the strategies that I haven't been able to use effectively or comfortably for a while here. I personally hope that and I know that we're just a little bit below the average over 25 years of the VIX. I hope that we're going to stay up at these slightly elevated levels. One, I think it makes more interesting. I think for those informed, educated, and skilled option traders, I think it creates more opportunity. As Dan was saying as well, it's an opportunity for both the buyers and it's an opportunity for the sellers as well. So, just think about people that are utilizing something as basic as covered calls in their portfolio to generate some income. They can generate more income, or they don't have to sell as many contracts to generate the same income. If you're selling covered calls and you're trying to generate $1,500 a month, like I was saying earlier, you'd have to sell 3 times the amount that you do right now to do that. Or people that have large cash positions, they're using that cash to sell some puts against that. They don't have to sell as many to go ahead and generate that. And also, you just don't have to buy as many options contracts to maybe ride the roller coaster as you did previously as well. So I like it. I hope that we are staying. I hope that we're going to stay maybe 18 to 22 on the VIX. That would be a nice level for us to be at for me personally. So, yeah, I'm seeing the polls come up here as well, that we've got people saying things are going great. And then I also see a pretty good number of people says I'm confused. So let's keep going with the Q&A then.
Yeah, that's exactly right. I was going to say the most popular answer agrees with you, that they agree these higher levels offer opportunities, but the majority of the crowd, close to 60% there, saying that they're either struggling or confused, which is perfectly fine. That's why we have these events to discuss volatility and how to analyze things. That's why the OIC exists. So hopefully you can become more comfortable as time goes on. Even the best and brightest traders struggle or get confused from time to time, but that's perfectly fine. The idea is stick with it. When you see these market conditions over and over again, time and time again over the years, you'll get more comfortable with that. So let's get a little more deep into this discussion on volatility. Dan, I'll turn to you. This idea of volatility skew, can you define for us what volatility skew is? I think I've heard the volatility smile referenced a number of times. Can you give our audience a description and definition of what skew is as it relates to options and volatility?
Sure, of course. Let's reminisce, not too long ago, about 5 minutes ago, to when Sean was describing what drives implied volatility levels. It's supply and demand, right? And so if you think about it, all options kind of serve a somewhat different purpose. You know, if we're looking at the SPY, for example, and it's trading at 268, for example, there might be a slightly different utility for buying maybe the 260 puts versus buying or selling the 275 call. You know, hedgers are a little bit more inclined to, buy puts rather than buy calls. And as far as the call side goes, there's plenty of people who speculate by buying calls, but then there's a whole bunch of people who like to generate income by trading covered calls. It's one of the most popular strategies. So there exists sort of like different supply and demand pressures for different options. So what skew is, at its base level, it's just simply the observation that what I just described exists, that different options on the same underlying can be trading at different implied volatility levels. So it kind of starts out with that general statement just as an observation, and then we can kind of really narrow in on that and use that to our advantage, and to be sure there's some professional traders who actually trade skew for a living. So it breaks down into two different types of skews. One is what we call the vertical skew or the strike skew. Now that's kind of the observation that I just described, that options on the same underlying within the same expiration will have different implied volatilities. Now, there tends to be a method to that. There tends to be an observable pattern. Often, not always, but often, the lower the strike, the higher the implied volatility on both calls or puts. And the higher the strike, to some degree, the lower the implied volatility on calls or puts. The other type of skew is what we call horizontal skew, time skew, or term structure of volatility. Now what that is the observation that options on the same underlying with the same strike, but in different expirations, can have different implied volatilities. Now, that one's a little bit more interesting to talk about. We can talk a whole bunch about it, but I'll just sort of break it down into the basics. There's a little bit less of an observable pattern there. What we tend to see is either the farther out in time the expiration is, the higher the implied volatility, or the other way around. The less amount of time until expiration, the higher the implied volatility. We typically don't see 40, 30, 50, 35, we don't see it like kind of go up and down. We see sort of a nice sloping, typically curved slope, but either higher or lower as we go to longer term expirations.
Dan, I picked up on something you said there that was all great. Up and down volatility skew. We have this sort of going out in time skew. You mentioned the observable characteristics of higher vols at lower strikes, lower vols at higher strikes, but I noticed you said often, not always. So can you elaborate, are there different skews other than that observable one that you mentioned, and under what conditions? What would drive, say, a skew that looks the exact opposite of that? Do we need to keep our eyes open for that as an investor?
Yeah, there's a number of factors, and one could be that it is simply like a different individual equity that just happens to trade differently. For example, a while back, Apple being America's stock, a lot of people couldn't afford to buy Apple at $800 a share, but loved to trade it. So they would buy calls. And back then, you would see actually the call skew, the higher strikes than the at the money, actually having a higher implied volatility. Why? Because people are buying. You might also see other things like, for example, gold ETFs or, treasury ETFs or something like that, where the perceived risk is maybe not to the downside, but to the upside in some cases, or, like oil, for example. You might, during some periods, see that skew not look like what I just described for a typical equity. But at the heart of this, there's actually just one really simple answer to what drives that and how do we observe the shapes of the volatilities for different assets. And it just goes back to what Sean was talking about. It goes back to it's supply and demand. I can sit here and I can come up with a bunch of reasons and kind of fill in the backstory as to, why some of these situations exist. But they exist because they exist. They exist because, buyers bid it up or sellers offer it lower. And the important thing is that we observe it. The important thing that we recognize that it's there because that drives our strategy selection and that helps us to make better trades. Make sense?
There's a lot of good insight there, and I think you said the key thing, supply and demand, again, does a lot of things, supply and demand, and in this case, as you mentioned, it can drive the implied volatility levels at specific strikes, and the observable normal volatility smile may or may not exist. We just have to keep our eyes open for that. Let me turn to you, Sean, now for this other question related to skew. The concept that Greeks and the factors that affect option prices are dynamic and constantly changing, and a particular strike price might be sliding up and down this skew and have its implied volatility levels change as the underlying changes. A deeper concept. Can you give our audience a description of how this works, what it means to move up and down this skew or this volatility curve?
Yeah, so one of the important things to keep in mind, and I get this question all the time, is when somebody is looking at an at-the-money option, say looking at an at-the-money call, and they see that they're buying an at-the-money call that has a 0.5 delta. And so if they don't understand that Greeks are dynamic and they change, then they think for every dollar change of the underlying stock that they'll be gaining or losing 50 cents. And then when they start to understand gamma, then they understand, hey, for the first dollar it went up, I made 50 cents, but on the second dollar it went up, I made 55 cents. Or the other way around, if it went down $1, I lost 50 cents, and then the second dollar I lost 45 cents. So they start to understand that these things are dynamic, but it's not just the delta that's it's not just the delta that is dynamic, but it's also the vega. And I know we really haven't gotten into vega yet, but if you start to look at the options on this sort of this vertical spectrum, and you start to compare all the Greeks, you'll start to see how going further in the money or out the money is changing each of the Greeks. And as such, if you've basically put your post in the ground with a particular option, be it an in the money, an at the money, or the out the money, then as the underlying stock moves up and down, making that in the money, at the money, out the money, as this thing has this price variation, you're going to see the Greeks change with that. So it's important that you understand how all of the Greeks are going to be moving in relationship to one another as well, and that's, you can see that in dynamic time if you're looking at an option chain or your real-time positions as well.
Yes, it's absolutely fascinating. That's a great description. And as you alluded to, Vega has popped its head up again in our discussion. So let's set the record straight on that and just quickly go through. Dan, can you give a description of what Vega is and maybe with a numeric example? What does it mean when you look at the options chain, you see a particular Vega? What does that tell the investor?
Yeah, like I described before, it's sort of the great translator. So every option has its unique implied level. So for example, maybe, and I actually don't have my trading screen open in front of me right now, but let's say that we're looking at the SPY 268 calls. And maybe they're trading at, just for example, 18 volatility level. So what if implied volatility rises by 1 point? You know, if I buy one of those 268 calls for, say, $2, expiration doesn't matter, I know that if I'm long a call, if implied volatility goes up, I should make money because I have positive exposure to implied volatility changes. But, you know, what is that? Like, you know, I kind of joke with our students, like I can't go to the bank and say, oh, you know, I made 1 volatility point. Can you give me a check for 1 volatility point? You know, no. So that's Vega's job. If implied volatility in those options goes from 18 to 19, my call is going to increase in value by the amount of the Vega. If the Vega is 5 cents, my call is going to go up from $2 to $2.05. Now, it's a little bit of sort of like a textbook utopian way to explain it. In reality, of course, a call is not worth $2. The call is like 198 bid at 201 or something like that. But we still see these changes. You know, we would see both the bid and the offer rise by the amount of the Vega when implied volatility goes up by a certain amount, by 1 point. And if implied volatility falls by 1 point, that option, both the bid and the offer, would fall by the amount of the Vega.
Okay, so there it is. There's your numeric example. Thanks, Dan. And that puts perspective into what we've been alluding to a few times earlier regarding Vega. Sean, any comments there about Vega before we move on to strategies? You know, how do you use Vega? How are you looking at Vega? How are you interpreting it when you make trading decisions?
Well, one of the first things I think everyone needs to decide is, are they going to be long Vega or short Vega? In other words, people very often will find themselves directional traders. Well, they always find themselves directional traders when they're buying stock or shorting a stock. They're determining the price. But if they don't understand the Greeks, if they don't understand implied volatility, they may not realize that they are also directional traders when it comes down to volatility. Now, instead of saying that volatility goes up and goes down, we usually say that volatility expands and contracts. So if, going back to my example where I was saying that that historical volatility had ranged from 20 to 50, if it's at 50 and I think that volatility is going to contract to sort of a midpoint here, let's say that midpoint is 35. So it's at 50 right now, and I've been watching volatility, and I see that it comes down to 49 and 48, and maybe there's no news over the horizon. It seems that everybody's taking vacations from Twitter and things like that. Then I may say, hey, I think the market's going to quiet down a little bit, and if the market quiets down some, then implied volatility is going to contract and revert down to the mean. If it contracts and reverts down to the mean, then that means the option that I sold is also going to be cheaper, which means that if I sold it at $5 and the market does what I think it's going to do, which is just settle down in volatility. It's not really a directional trade, but I'm saying the market direction, I'm saying the volatility is going to contract. That is a directional trade. If I sold it for $5 and I can buy it back for $3, just because volatility contracted, great, there's a profit there. Now, on the flip side of that, and how am I going to calculate that profitability? If I think that volatility is going to go from a 48 vol all the way down to a 35, then I can calculate using Vega how much money I'm going to make by being able to sell something high and buy it back low. On the flip side of the 20 to 50 range, if it's 20 and I think that, hey, because of this event that the CEO tweeted out that's still 4 weeks away, I think volatility is going to really expand. And we're going to go from 20 at least to our mean of 35, but maybe we're going to get higher. Then if I see that we've got a 15-point implied volatility move, what's a 15-point implied volatility move going to do for my profitability? Well, that's where Vega comes in. So if I expect the expansion of volatility while volatility is low in the range, I want to be buying call options because that expansion is going to benefit me. Whereas if I see a contraction, then I want to be selling that volatility and taking advantage of being short the Vega as things come down. So I know we're starting to get into some strategy talks here, but that's how I would be looking at Vega if I'm going to be long or short it. Where are we at in the range, and what direction do I think it's going to go, expand or contract?
And that's great, and that leads us right into our last segment. We just have a few minutes left, so in a minute or so, Dan, just an indication to the audience. If you're looking to buy volatility, what types of strategies come to your mind right away?
Well, the answer really is it depends. If I have a directional bias, of course, I would think about buying a call if I'm bullish. Although, if I really want to buy implied volatility, I would do that. But if I just sort of tepidly want to buy implied volatility, like I want some positive exposure and bullish exposure, I'd buy a debit spread with the long strike at the money. Now, if I want to really narrow in and focus really on a pure volatility trade, the one that comes to mind is a straddle, because there I'm buying two options, so I'm sort of buying double volatility, double implied volatility exposure, double Vega.
Good stuff, Dan. And Sean, from your side, I think you forecasted this a bit. If you're looking to sell options, of course, that means you're shorting Vega, you're selling options. A little bit of risk there. So is there a different approach managing that risk when you're trying to sell implied volatility?
Yeah, so when you're trying to sell it, obviously you would benefit from a contraction. So you'd be negative Vega, but you want to go ahead and see a contraction in there. So covered calls, well, let's keep it simple. Covered calls and secured puts, some people call them naked puts. Basically, you're selling puts and you're expecting, both of these are somewhat directional moves, but both of these would benefit from a contraction in volatility. You'd be short Vegas there. And then kicking it up a little bit more, also credit spreads. Anytime you're doing any sort of a credit trade, so a credit spread, you're either doing a bull put or bear call. And as Dan said, first you need to also figure out your directional bias here. You can't turn a blind eye to market direction when you're trading those strategies. But getting into a little bit more pure volatility plays, things like an iron butterfly, which is really just a naked straddle. Going back to my example of the $100 stock, and you look at the $100 put that was $3 and the $100 call that was $3. Well, the idea is you're going to sell, instead of buying those, you're going to sell those and you're going to bring in a credit of $6. Now, hopefully everybody's recognizing that by doing this naked straddle that you have unlimited risk to the upside, which of course means automatically you can't do this strategy in your retirement account. So you're going to have to find a way to hedge that position. It'd be great if we could all run around doing naked straddles, but they do have unlimited risk, and I don't sleep at night with that kind of thing. So a naked straddle, if you were to take some of the premium that you brought in and buy yourself an out-the-money or further out-the-money call option as basically a way to protect or hedge or define the risk, but also spend more of the money and buy yourself a put option, in that case, then you have an iron butterfly. So an iron butterfly is selling Vega and will benefit from a contraction, and basically you're market neutral. Similar would be an iron condor, where you're doing a naked strangle, except that you're spending some of the money on the naked strangle and you're buying yourself a call and buying yourself a put, which changes it from unlimited risk to defined risk as well. So, going from basic Vega, short Vega strategies to a little bit more advanced short Vega strategies in those.
Very good stuff, and I don't know how you guys feel. I wish I had another hour here to keep going, but we're bumping up against the top of the hour. So the first thing I want to mention to our audience is please take the surveys. We appreciate that feedback. We look at every single comment and every single answer. Helps us shape our program as we move into the future. Visit the website. We do have a volatility course that addresses a lot of these topics we've discussed today, along with some mathematics and some deep analysis of how volatility is calculated. So visit our options education program, take the MyPath assessment, view our course catalog, check out the volatility course, and reach out to us, not just through the website. Also contact me and my team at Investor Services through our email address. Visit the YouTube channel, Facebook, Twitter, attend all of our events, and hopefully we'll be seeing you again sometime soon. With that, Alex, I'll turn things back over to you.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email Joe Burgoyne at options@theocc.com or visit optionseducation.org and chat with Investor Services. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu and Instagram at optionseducation, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.